Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closer Show. As always, Scott Carson, excited to be here with you. And I'm really, really excited to have a fellow mortgage, expert on the call here today and the webinar and the podcast for you guys all here. So excited. I mean, many of you know that I got my feet wet originally in the mortgage industry back in 2001. Started a mortgage business that was doing mortgages in 30 states for investors. So I always love talking mortgage rates in the markets and things like that with other experts and brokers out there. And I am honored to have one of the best in the industry who is just absolutely killing it, doing amazing things for her clients as well out there. And, she's been helping her clients for over 23 years with their mortgage investments and insurance needs. She's the CEO of DLB Mortgage Services and helps create wealth and peace of mind for clients across the country. She's also a radio show host of Money Strategies with Debbie, where she hands out advice for listeners on how to live within their means, which most people don't, and how to make money stretch, and shows them the risk in their plans. She makes complicated financial news easy to understand. Our guest, Debbie Bloyd, is focused on her clients' finances and speaks frequently with university students and business classes about money and finances for themselves and their small business. So we are honored to have the mortgage rock star, Miss Debbie Bloyd, joining us today here on the Note Closer Show.
Thanks so much.
No, honored to have you. I mean, we're kind of talking end of the year, and a lot of things are going on. And I know you and I were talking beforehand that, hey, we're always trying to get things closed out by the end of the month or the end of the quarter and things like that. How's the year shaping up in the industry and for you, Debbie?
I've personally been slammed, so it's been good. It's a good year, but it's always a good year. You have to look for the upside on everything. So we do still have people trying to get their houses done by the end of the year. They're still trying to move here from other places. Maybe they've gone somewhere for a couple years. Now they've come back to wherever back is, or they want to retire and move somewhere else, and we're the somewhere else, and I have their loan. So I've got people moving all around the place, Canada back to Texas, California, Colorado to Texas. I do loans mostly in Texas, Arizona, Florida, and people are still moving around. I don't know what all this talk is about a slowdown, because I'm not slow at all.
Well, that's the thing. You've been in the industry for a little while now, and those that have been around through a couple ups and downs.
Couple decades, yeah. That's a long time, yeah.
Well, let's not say that. It's been interesting times, but that's what I always say is anybody, and we see that especially here in Austin and in Texas, a lot of realtors, a lot of mortgages, brokers and bankers jump in when the market's going up. It's those that have been through ups and downs that you really want to work with, because they understand the market. They have a true business, and they've seen it. They've been to the circus a couple times,
right?
And really can advise clients on what's good and what's bad these days, right?
There's always an upside to the market. You know this. When times get tough and people go through foreclosures, you buy. So there is a benefit. When interest rates were really high, not everybody could afford to buy, so they were renters. Great time to be an investor. Same thing happens now. Rates are low. A lot of people are jumping in and buying. They're upgrading. They're spending more money. But at the same time, I think it comes down to what's going on with your family, your little dynamic of your slice of the world. A lot of people don't care who the president is, if they're impeached or not. It just makes the markets go crazy. But it does not affect you or me personally unless we know them. So I don't care. I'm still going to have to pay my bills at the end of the month, regardless of who's president.
Yeah, that's right. The days of either Obama or Trump coming in to save you
I don't care.
Never existed, right?
Nobody's saving me. So if they're saving you, God bless you, but nobody's saving me.
Yeah. So one of the things, and I think a lot of people, we've got a lot of different people on this call. We've got investors, we've got people looking to invest, we got people looking to buy maybe for the first time. I've got a couple of friends that have been going through kind of the process here locally, or actually outside of the state, getting started some things. What are some of the biggest mistakes that you see first-time home buyers making out there that maybe gets them in trouble that they don't think about?
I just had a closing that took 2 weeks because a home buyer decided to not do what we said and created a lot of havoc. So, an older lady, she's so super nice, was buying a second home here in Texas, getting out of California. And part of the qualifications was she had to pay off some bills at closing. The title company will give her checks to pay those bills off. And we were supposed to close. And then she started doing stuff by herself. And she got online and decided to pay off all these credit cards over the weekend before her closing. And You're laughing. It's terrible. So the credit report now didn't match anything. The title company didn't have the right receipts. She'd spent some of the money that she should have had as a reserve. You're laughing because you've done all this. Terrible. So people, quit doing crap we tell you not to do. I definitely tell people, do not do anything that I don't tell you to do, and they still do it. Yeah.
Oh, yeah.
It happens all the time.
Yeah, it happens all the time. Let's go pay off some bills. Oh, let's go buy some new furniture for the new house.
Yeah, because, there's a sale on, and we're just going to get all of our appliances now. And it says that we don't have to pay today. We just put it off, and they'll bill us. And so it's postponed. So it shouldn't affect our credit at all. No, because they did a credit inquiry, and now they found out that you went to Lowe's and spent $5,000, and now you don't qualify because they got to hit you with that payment, whether you have to start paying now or in 90 days. So when we say don't buy a new car, we mean don't buy a new car. And we know if you buy a new car. So knock it off. Yeah. it's awful. Yeah. You know, and then people, just the way they live is just weird. And they don't think they're weird, but to come to my world, it's super weird. So, I had a client wants to buy a house, gets written, he works at a company. It's a mom and pop company. They write checks like you and I write checks out of a little checkbook, if anyone even has one of those anymore. So he doesn't have a normal pay stub like everybody else. And so they think that's okay to qualify. Like, no, nobody does this, but this company does this. And I'm like, well, then this company is not allowing you to buy a house because this doesn't fly in our world. So it looks weird, so it's a general ledger. Who even keeps that anymore? So yeah, you're laughing because it's true. And it's
I know exactly what you're doing. Yeah.
I had a guy call me last night, and he was self-employed, trying to qualify him, writes everything off on his taxes, and so I said, so, tell me about your work history, and he's self-employed. And then as I'm asking him, how much he makes last year, he goes, well, I didn't work a lot of last year because I was sick and I got hurt, and, I stayed home. And I'm like, oh my God, what were your taxes? And he's like, oh, well, maybe $12,000. I'm like, yeah, you're not going to buy anything with that. And I said, so what have you saved for a down payment? He's like, well, I was going to talk to you about like that. So how does that work? I'm like, you have to have money for a down payment, honey. So there's a few loans that still do 0 down, but those are few and far between, and you still have to qualify. So it's a lot of education. And if everybody says everything's on the internet, they should know. Yes, they should. But they don't. And so I spend my time telling people, don't pay off your bills after we've qualified you. Don't be sick for a year and not work and then expect to buy a house. Don't come to me with no down payment. Don't come to me with handwritten checks. All those things are bad.
Yeah.
And I'm supposed to make sense of them.
So let's talk a little bit about that, because we've got a lot of entrepreneurs out in our network out there, out in Note Nation.
Sure.
You say, so, and then so you brought up a couple points, and I've talked to people that, I can't qualify for a traditional house. I'm like, wait a second. If you start planning ahead, if you start putting the things in place, you can qualify. Because I think
they have some new loans now. So the world that you remember pre-2008 is coming back around. And now they don't call them a stated loan or a no-doc loan, because those are bad words. We now call them bank statement loans. So what that means is I take a year of your bank statements or 2 years of your bank statements, and we actually send those to the underwriters, tons of pages. I mean, hundreds and hundreds of pages of bank statements. And they add them all up, divide by 24 months, and they give me the income that you're going to be using. So that is if you make the deposits. Now, if you live in cash, I'm still not going to be able to help you. But as long as it gets to the bank at some point and we can show deposits, you win. It's a great system. Now, you pay a little bit higher interest rate by a couple points. So right now, everybody's in the 3s, usually with good credit. These guys are paying in the 6s. But you haven't, in theory, how do you say this right? In theory, you haven't paid taxes probably on some of that money, but it did hit your bank. So then now we can use it to qualify you. So these loans are becoming more prevalent for all my self-employed people because they have been on the sidelines for years.
So that anytime they've got, so basically as they're closing on deals or doing things,
put the money in the bank.
Put the money in the bank, put it in your personal accounts, run it through there, look like you're paying yourself, right? Versus
well, you don't even have to pay yourself. All I care about is the deposits. So if you have a personal account, fine. If you have a business account, fine. Just get the money in one side or another, and we call it income. So if you sell a property, that's income. If you spend it, we're not, see, the beauty is like the stated loans where we're not checking on what you spend it on, we're checking on what comes in. Mm-hmm. So if you can just bring it to the bank, we can use it. If you cash it before it gets to the bank, I can't use it. So if people are self-employed, what you're asking for is a bank statement loan. That's what you're going to tell people. Now, not everybody signed up to do those. I was vice president of a bank for a few years, and I turned a lot of people away. And I don't like that because, everybody counts on you in the lending business. They make a mess, and we're supposed to make them package them enough to get a mortgage. And I just had to turn too many people away. So now as a broker, I'm able to do a lot of bank statement loans and help people. There's even some really bad credit score loans still out there. So as long as you're 580 or above, you can still get a loan. It's going to be a little pricey, but you can get it.
That was going to be my next question. What are you seeing with, subprime is now called the non-prime loans, the
don't call subprime. No, don't say that word. Dirty word. Dirty word.
Good word in my neck of the woods because we would buy a lot of that stuff. But
right.
What are you seeing out there in the market? I know we're talking because you're primarily doing, like you said, doing Texas, Arizona, Texas, and Florida, which are three of the big markets that we do there. But what are you seeing as far as non-prime programs? As far as like credit scores, down payment requirements, or anything like that?
Well, the bank statement loans, the catch on those is you got to have 10% down. But if you're bringing all that money in, you should be able to scrounge up 10%. That can't be gift money. It has to come from your accounts. The subprime loans that we're used to call go down to 550. Of course, they're going to charge you 8%, and you have to put 10%, 15% down. So there's penalties for that, but at least you get to do it now, where before we couldn't do it at all. So that blessing is there. You just got to pay more for it. So a lot of people, when we do the analysis of their self-employment, would they rather pay Uncle Sam or rather pay a higher interest rate? They're going to pay somebody. It's just who do you want to pay? You can't keep it all unless you save it all up and just buy cash. And you can always do that. Yeah.
It's interesting to see. Are you seeing, in my offices where I used to live, there would be new mortgage companies popping up every day and that stuff. I'm sure you're seeing a lot of these companies popping up. Yeah, I think back to when New Century was in business, and you had Option One and First Magnus, and everybody was getting greedy trying to do anything.
I had a Rolodex of subprime lenders. And then when Bank of America failed that day, remember that day? It was a terrible day. Rates were like 4, and then all of a sudden they shot up to 6. In one day when Bank of America failed. So all the subprime lenders went out of business that day. Like the phones just disconnected, and we lost everything that was in the pipeline because there was nowhere to place it. So we don't miss those days with stated stuff. It's not quite the Wild Wild West. It's kind of like the Midwest now. So there are some problems, not a lot. Most people, when they come in, if they have bad credit, they tell you that up front, and I can tell them up front, okay, we're more educated now. Back in the day, I used to print off a credit report 20 years ago. The bank owned it. I couldn't show it to the person. I merely said, I'm sorry, I can't help you. Come back when you're better. And that's really all we could say. Now, people can get a free credit report every 6 months by all of the 3. So there is ways to do, but some of the stuff that's out there is not real. And people say, well, Credit Karma, I've got whatever score. And I'm like, okay, that's not real. Now
that's a FACO versus a FICO, as our buddy Merrill Chandler with Credit Sense likes to say. It's a FACO score versus a FICO score. Yeah.
Right. So, you would think everyone was educated. When I first got on the radio, I thought if I could just tell people how to fix their credit and clean stuff up, if they were just educated, they'd be so much better. And I'll do this for a couple months and I'll clean up my town. And that didn't work. And I'm still seeing the same things.
No,
hasn't changed a bit.
Exactly. So those that are in, one of the things that we deal with a lot of borrowers, obviously, that have stopped making payments or been hit and miss. And so we buy that debt. And people, we're working with trial payment plans, even loan modifications, to go out and get refinanced out. And, somebody who's looking to get refinanced, they still need to have 24 months of on-time payments or 12 months of on-time payments.
12 months.
12 months?
12
Okay.
months. Yeah, they can't have been late in the last 12 months. They've got to be current on their taxes. And a lot of time that's, at the first of the year, we'll have issues with people not paying their taxes. And, I think that speaks to the overall financial, and you can speak to this more than I can. Most people don't have a lot saved up. When they come to me, I've got a couple I'm refinancing now, live in a $400,000 house. They have $1,000 cash. They have maybe $800,000 in a 401k that they don't have access to yet, but they're cash poor. And so a lot of people are stuff rich, cash poor. And that doesn't help when you finance either, because now everything is automated. So the only loans that are truly underwritten the way you and I remember it is a real underwriter person is these bank statement loans. Everything else goes through an automated system. And what I always explain to people is, no, I'm not going to make you cash out of your 401k. Just give me the balances and the statements. I have to make you look good to the computer. And they're like, what? And I'm like, the more stuff we give it, the happier it is and the easier you are to get approved. So give me all your stuff and let me sort it out to get you an approval, because now we're making a computer happy, not a person.
Mm-hmm.
Same premise.
It totally makes sense. And we've heard that. And we've heard that we've got a sponsor, like I said, Merrill Chandler, who does with Credit Sense. He just went to FICO World, which is their big annual conference they do in New York every 18 months, and came back with a lot, talking about how there's all these little things in the algorithm that you've got to make the computer, the AI happy versus common sense underwriting in a lot of cases.
Right. So people still need, like I talked to a kid last night, he's a few payments away from having his car paid off. So we don't count it, but his score is still low. He's maxed out on all his credit cards. And I was like, if you could just get those down to 30%. And his attitude is, why you get them to 30%, I just pay them off. I'm like, well, yeah, that would be the best, but maxing them out at 80%, 90% is lowering your credit score. And then if you go get a payday loan or some kind of loan to pay those off, then you've just admitted that you can't do this by yourself. And the algorithms know that. And then they say, okay, you can't money manage. So, then that hits you too. So a lot of this is just, don't live like that. But of course, everybody, the way they pay their bills and live is the way they think everybody pays their bills and lives. And that's just not true. They're not taught that. No one's taught that. So they should teach that in school. They should, I taught my kids that, but I talk it all the time. So.
Yeah. We live in such a highly financially uneducated society out there. I mean, they barely taught us how to balance a checkbook when I was in high school, and they don't even do that anymore. And
my kids just swipe that card, and as long as they're swiping and it keeps, my daughter is in college. My son's also in college, and they, I don't give them debit cards. I give them a credit card because they had no idea. And I just tell them how much they can spend, and they have to keep track of it, and they get in trouble if they go over, but they would just swipe that debit card and they would be like somewhere to eat. And they just swipe it like, hope it works. Hope I get food today. And I'm like, no. We don't do that. And, people are just, no. But, people do that with their checkbooks. And this is the time of year while people are trying to figure out how to get more cash. I do a lot of cash out refinances right now. And they said, I'm just going to pay stuff off. And I'm like, let's pay it off responsibly. Let's pay off the high interest rate stuff first. And like, I have a car note for my son. He's on credit with me so that he gets to have a credit score. I'm trying to help him. You've got to keep him, we've got to keep paying on that note for at least 9 months for that to affect his credit score and him to have a credit score. So I don't know, I've got like 2% interest. For 2%, I can get my kid a better credit score. I'll do it. Put my daughter onto my American Express card. I pay on time. That's going to benefit her. So, once they're out of college, they're on their own. So they're going to have a credit score. So many people don't help their kids. They give them stuff, but they don't teach them how to fish themselves. So if I can provide them with a decent credit score going out there, then the rest is up to them. But every parent can do that. If they have a credit card, they can put their kid on it and help their kids along too.
Yeah, there's some great tips and advice out there for folks that have got kids in college or getting ready to go to college and that aspect of things. But yeah, I like the idea of putting a credit card because there's a limit there versus them just swiping a debit card and then suddenly you've overdrawn your account and you've got.
And so like 2 years ago with remember the Experian hack that there was? So I got my credit stolen. So out of personal experience, I can say it's not fun. So they took money out of my account and put it in, and my kids were minors then. So the money went from my account to their account, and then the people ACH'd it out. So it would come out of my kids' account. So then we had to break up all the accounts so they weren't connected. So then my kids were all by themselves. Well, they thought that was amazing until they found out that I could not put money in their account. Because if you're not on the account, you can't put money in. You have to put in check, you can't put in cash or a cashier's check. So they can, of course, trace it. So, being all alone and being all grown up is great if you know what that means. So for some of our borrowers, they're first-time home buyers, they're still on their parents' cell phone bills. They're still covered under their parents' insurance. They don't know what any of this means.
Do you foresee, or are you already seeing pick-a-pays coming back into the market like they used to be?
Yeah, I think so, because people are going to, they're stretched. I don't care how pretty of a house you live in, how beautiful of a car you lease. You're probably only a few payments away, a few paychecks away from not being able to afford that lifestyle. And I don't think people think that. I think they think everybody in those $1 million houses are just flush with cash. And, now is the time, look at you, you're going, no. But now is the time to leverage money. Money is cheap. So there is a fine line between, like some people say, I'm going to put 20% down, or I'm not going to do it. You don't have to. Leverage your money while money's cheap. Just do it smartly and know what you have to be responsible for. But when money is this cheap, now is the time to buy stuff. Now is the time to do what you do, invest it.
Yeah, that's the thing. If you can get into a similar loan with 3% down versus 20% down, that 17% difference in what you're putting down isn't making any money. It's sitting there saving you 3% on that 17 grand when you could be out making 6, 8, 10, 12 or greater percent by leveraging. You're 100% right.
You know who you're going to see more as investors are these older baby boomers. I'm a baby boomer. I didn't know at 55 I'm considered a baby boomer. But a lot of my clients are now doing reverse mortgages, and everybody thinks it's a last-ditch effort to survive, and that's not true. I had a guy just in Georgetown sell $1 million house. He bought a brand new David Weekley house, new construction made just for him. It was $400,000. He heard me talk about reverse mortgages, and he ended up putting $182,000 down, never making another house payment, only paying his insurance and taxes. Now that extra $200,000, he went and bought 2 rental properties. So now he has cash flow. So it's reutilizing your money, moving your money into something that is making you money. Because at a certain point of your age, it's not about your stuff anymore and the golden egg that you're sitting on. It's cash flow. You need more cash flow to pay medical bills and health issues. And people don't, I guess that we don't think we're going to get old, and so we're not planning for it. So it surprises everyone when they hit 70 and they have a health problem. They need cash out. So that's what I'm seeing as well. But they are buying rental properties.
Yeah, we're seeing some things that based on the stats we're seeing that 1 out of every 10 individuals is already 30 days late on their mortgage, which is sad. They're not saving. Obviously, we know this. They're not saving. We're still at a negative savings ratio. But we mentioned a few minutes ago about the pick-a-pays, and I want to kind of discuss that a little bit, because most people don't know what that is. And it's basically it's a mortgage where you've got like 4 options. You've got the option to make a full 30-year mortgage payment, principal and interest.
These were all the rage. All the rage. I don't know why they all stopped, because it was a great premise for people.
Well, they were a great premise because you could do a partial interest payment with like 1%, 1.5%. It was your primary residence, or 2.5%. It was an investment property. So if your interest rate was 6 or 7, that difference between the 1% and the 6% went onto the face amount of the loan. Right. And that could grow until you hit 125% LTV. And then, of course, you had the 15-year, 30-year, the partial payment or the full interest payment. Well, what did most people pay? They paid that partial interest payment. And then they did that for a while until the market changed. And then suddenly, now they've got to pay the full 30-year mortgage payment with all this extra amortization. They're upside down their houses. And I think it's what led to the downfall.
But it worked out well for certain income people.
Yes. That took that difference and leveraged it and went and bought real estate, went and invested that difference, and were able to do that. You're 100% right on that. It wasn't for everybody. It wasn't even for most people. It was only for partial people. But everybody was like, I can pay 1% interest rate? No, your loan's 6%. What do you think is going to happen with that different 5%? Oh no, I want the 1%. I'm like, oh, it doesn't work that way. But
well, and it worked out well for people that didn't have consistent income.
Mm-hmm.
But they have to be regulated. Well, so that's your realtors, your self-employed people. So, if you didn't make any money for 2 months, you could make that minimum payment, and then you could move it back up when you sold that big thing, whatever it was, and get caught up. But nobody self-regulated very well. So they spent it all and then they had nothing, and they spent it all and they had nothing. So while that was a great premise to help them, they weren't very well regulated to start with.
Right. Now with the investor loans out there, it's still a maximum of 10 mortgages on for someone to get a traditional mortgage.
It is, but that non-QM stuff, that weird subprime-ish kind of stuff now.
Wait, non-prime. Non-prime,
not prime. Yeah, not prime. That non-QM. Some of those have more properties than 10. Of course, you pay that in the interest rate, but they let you do more than 10. So they are out there. There are companies cropping up that do that.
That's good. And so what are you seeing that a lot of those maybe programs require for underwriting? You're still talking about 2 years of bank statements and a pretty decent FICO score, I imagine.
Oh yeah, you've got to have 680 or above. Some of those things require 720 or above. That's really the max that they require, 720. So if you can get it up to there, you can do a lot. That's the magic number now. But you do have to realize there's a payoff for that. There's going to be a payoff down the road, and you're going to have to pay. So it may not be right up front, but it does enable people. There are wheeler dealers. You know them all. You're one of them. Find a good deal, move it around here, sell that, do this, and it's a game. So if you think about money as a shell game, you're fine, but you better win at that game. Now, I don't say go to Vegas. I'm not a Vegas girl. I can blow $100, at the blackjack table, and then I'm done, because that was my fun money. But to really play that game, you have to be able to buy the market right and sell at the market right. And very few people are that good. So buy and hold has always been the strategy. And I know you're taking people out of distressed instances and moving them to a better spot. You hope they learn their lesson. But, this would be a great time to take advantage of the market. So people say, what does 2020 look like? Well, there's going to be a lot of political unrest. There's a lot going on right now. It doesn't matter to most of us who is in where, but it makes the markets crazy. So if we look at our families, if you think you have great job security, you're upper management, owner of a business, all that is thriving, you're just going to keep going. It doesn't matter. If you're a wage earner at the bottom part and you're not for sure if your company is going to keep going or not, if you're going to get laid off, you're not going to move. So that means you're not going to improve things. You're not going to go buy any new things. And that means if you're renting, you're not going to start buying all of a sudden. You're going to stay a renter. So as people don't pay their taxes, as interest rates go up, as people fall behind, you're going to come in, take over their properties. They're going to stay renters. Great time for investors. So someone asked me the other day, what does the next year look like? It's a great year. It's a great year on one side or the other. Either we're going to be buying stuff that we can afford, or we're going to be buying stuff that other people couldn't afford as investors. So there's always an upside to every market. If the stock market goes down, there are people waiting for it to bottom out so they can buy all that stuff on sale and ride it back up. Same thing with rental property.
That makes so much sense. You took the questions right out of my mouth. I was about to ask you on a couple there, but that's true. There's ups and signs. If you know how to make money, either whether you're buying or you're taking over what something else can buy, there's opportunities there. You just got to know where to look, and you got to be a little flexible. But you said something really critical there before that. If people are looking at their income, whether they're working entry level or they're upper management or in the middle management stuff, one thing they've got to do is they've got to make sure they've got some sort of reserves more than anything else in case of a job loss.
Well, and very few, probably out of my 10, 12 loans I'm doing now, there's probably 6 that have reserves. Everybody else is just a couple paychecks away. They have just enough to get in the new house so the computer likes them, but they don't have anything else. So if they lost their job, they don't have 2 months of reserves, let alone 6 months. They better, no, they're just not ready. They're not prepared. We're not prepared for a downturn as an economy. If we have one, not a lot of people are prepared. So that means great news for your business. I'm looking for rental property too, like you all the time. And I'm up here in Dallas. I can't find any foreclosures. I can't find some of the stuff that I want to buy. So I wait. And so there's a lot of people with cash on the sidelines, and we're just waiting for something to happen because there's not a lot of for sale by owners. That open door and all that stuff has kind of taken over that part of the market. And that's fine. We're also seeing a lot of first-time home buyers. They don't want to fix and flip. They don't want to even fix. They want to come into gorgeous. And that is a benefit to people like me and you that can do those kind of things and make the properties look nicer and put renters in them. So I think there's a matter how it turns out.
Yeah, we were going to see. I think we're going to see.
At least that's what I'm telling myself.
Well, I know that we're seeing the higher priced homes, the $500,000 or higher loans, properties starting to soften. Days on market starting to increase. Short sales in those markets are starting to increase as people bought too high, thought they could fix and flip, and then the market's kind of turned a little bit on them. But you're right there. I mean, pay attention. Great time to be holding on to money when something does come in, or even looking maybe in secondary markets, maybe not Dallas, maybe outside, just outside of Dallas, maybe Paris or Greenville or some places like those areas up that neighborhood.
I just had a guy move to Paris next week. He closes next week from Colorado. Tired of the snow. Things are very affordable. So I've been Googling Paris, finding out what's in Paris. Very beautiful, nice homes at a fraction of what it would cost you in the big city. So I think the suburbs are growing. If you know anything about all of our markets, the suburbs, Austin is, I don't know, it's just a big, suburbs are part of Austin now. It's just a huge mecca, and you can't really tell the difference. And people are driving an hour to get to work one way. And I think you're going to see a real resurgence of downtowns because these millennials don't want to do that. They don't want to sit in their car an hour. They're going to change the way downtowns work.
Yeah, they can, for half the price of a downtown condo, they can get a house, a yard. There's some things there, especially they start having families and pets and kind of going through that transition. Sure. I wanted to ask you a little bit, because we get people, one of the things that we get from time to time from banks, we'll get lists of reverse mortgages that we can cherry pick by buying the debt on. So can you kind of go through kind of what the basis is of somebody that's going to go and looking for a loan, a reverse mortgage loan, kind of, what's the age, what's the, LTV percentages that you see, and kind of what it is actually for those.
Sure. So the way a reverse mortgage works, there's an FHA reverse mortgage, and then there's proprietary products. The companies that do the FHA loans have come up with their own things that maybe fit a niche so FHA, the rules are you have to be 62 years of age or older. So these proprietary products by two big companies start at 60. So so they're trying to undercut the FHA. FHA has mortgage insurance, just like they do for first-time home buyers. So if you have mortgage insurance as a first-time home buyer, you have mortgage insurance as an FHA reverse. Mortgage insurance is expensive. It never comes off the loan. Doesn't for first-time home buyers, doesn't for reverses. These proprietary products doesn't have mortgage insurance. That means your money lasts longer in the product than it's going to another fee. So that's why some people like these. Basically what we're doing is we're taking their age, their birthday, their name and their address, how much they owe on their house, and how much their house is worth. We put that in the computer, and of course the algorithms, the computer, got to make the computer happy. The computer spits out to us, we all run the same software. It's called Reverse Vision. You put it in there, it tells you how much you can get out based on your age. So the algorithms used to take you to like 80. Okay, have you noticed that there's a lot of people that are 100 now? So now they had to change the programs. Now they're taking us out to 99. So they're saying, okay, you and I are probably going to live into our 90s. So they have to leave enough equity in the house for the house to pay for itself until you die in your 90s. So for me, that's 40 more years of stuff that I've got to pay for. So I don't get that much equity out. What we were doing and what we saw and why reverses got a bad rap is, and when we started 15 years ago, we were giving them a lot of money out. People that were right at the edge. So when you're right at the edge and you have no money, and now your house is safe, but we somehow thought they could not money manage very well. So we're going to make them pay their own taxes and insurance. Okay, so a lot of those people took all the money that we gave them out and went and spent it on things. And then the next year they didn't have time and money saved aside to pay their taxes and insurance. And the headlines were reverse mortgages, oust grandma from her house. And we were the bad guys when grandma was told to pay taxes and insurance. So you got to pay it. Or you and I would also get kicked out of our house with Wells Fargo if we didn't pay our taxes and insurance. So it got a bad rap. The money wasn't, too much money was given without any strings. And so the loans have been changing over the years now. There's an investment vehicle inside there, so you can leave money in the house if you don't need it as cash out in a lump sum or a monthly salary. It actually earns 5% interest. So now people are going, oh, I can leave it in there and it can make money and I can have it if I need it, like an emergency. So we have a more sophisticated buyer doing it. So we have people buying in their $600,000 houses that they paid cash for, because all of our lives, maybe you and I don't believe in this, but everybody else seems to. You've got to own your house free and clear, and then you're set. Well, your taxes, that's not true. And why do you want all of your money at that golden egg that you're sitting on that you don't have access to? Mm-hmm. So then they come to do a reverse. Well, they can't. The reason they're doing reverse is they can't always qualify for a refinance like you and I could, because number one, they don't have income now. They're maybe on Social Security, right. And their bills are probably higher because they're charging more because Social Security is not enough to keep them. And so they have high credit card bills, which means their credit scores are a lot lower. Now, they've also co-signed for their kids and grandkids on cars and stuff. Those kids do not make payments. So a lot of times grandma and grandpa have really crappy credit now, where they used to be in the 800s, they're now down in the 500s because someone has gotten a car taken back. So they've run into problems. Well, a reverse is the only loan that's out there that is not credit driven. So the house takes over the payments, the house insures the house, not the people. So it doesn't matter if grandma has bad credit. If grandma has a decent house, the house can pay for the house. So that's enabling people to get more money back in circulation. Also, because it's not a desperation loan now, it's considered a financial tool. We've attracted a lot more sophisticated people doing it. So like in Georgetown where you're at, I'm there a couple times a month doing little dinner talks and explaining to people how they can utilize this to spread their money out. So now, instead of taking money out of their IRAs and their 401ks that they can't get back, take it out of their house first, let that money continue to grow in their IRAs, and it's restructuring their financial status, not just taking money down, because when you start taking money out of an IRA, it's going to be gone.
Mm-hmm. And there's taking a lot of that equity and kind of turning the house into kind of an annuity aspect of things, right? That allows them to grow, controls that stuff, and gives them some of the equity back to do some things. And then what happens when they pass away? So that's the big bit of information. Everybody goes, so the bank owns my house. I'm like, no more than Wells Fargo would own my house right now if I died. I have a will. Hopefully, and a lot of people don't. That's another thing. Duh, get a will. So you have an executor of that will, and that person has to get rid of all your stuff or invest all your stuff or move all your stuff. Same thing with your house. They have to sell the house, pay off the loan. If there's any equity left between what you owe and what you earn, the estate gets that. If there is a shortfall, if you owe $300 on your house and your house is deteriorated, it's only worth $200. Now that $100,000, the spread, you would consider a short sale. Well, in our world, as a reverse mortgage, that's not a short sale anymore. Now FHA comes in and pays that difference. So the estate's not on the ticket. So otherwise, the estate would have to pick up that $100,000, and all that money grandma kept in her IRA or mutual fund is now gone to pay off an upside down house, like it would for me or you. Mm-hmm. Once it's in a reverse and it's an FHA guaranteed reverse, FHA pays for that. So it's a safety net. Of course, you're using grandma's money now to let her live on rather than she give it away when she ages. So that's the other wrinkle that makes a lot of families mad. This is a very volatile subject, and it happens around the holidays because I've talked to several parents in their 70s, 80s, whatever. And they say, well, what, let me just run this by my kids and let them know. And I'm like, okay, that's a blessing and not, because if your kids want the house free and clear, they're going to be mad and not going to want you to do it. If their kids are so much better off than you are, they're not going to care. They're going to want mom and dad to have the money that they need to survive. Because if mom and dad can't make their bills, then the kids are going to have to pitch in. Or mom and dad's going to have to sell the house and move in with the kids. So do you want to help them, or do you want them to help themselves with a reverse? Your choice. But something that someone's going to have to help somewhere. And so that's the big amount of information that people don't understand, is that it's actually safer for your family. No, I agree. I 100% agree. people need to make decisions based on their financial situation, not what their kids are, not what their grandkids are doing, but what's going to take care of them. And we see, seen that, and I hear your heartstrings in there, how big a heart you have to helping people, because it's the same thing.
It's sad. It's sad when people, because all this ties into the other stuff that I do, because I also do like long-term care insurance and I do insurance. So a lot of people don't think they need long-term care because one lady said, Debbie, I don't want to hear about long-term care anymore. I'm going to die healthy. And I said, okay, you just keep thinking that. But for me, I got long-term care a couple years ago, and I told my kids, Merry Christmas to you. I got a long-term care policy. And they're like, do we care? And I'm like, you will, because you won't be taking care of me. There's hybrid policies now that will pay off. So if I'm hit by a bus today, it pays off like a death benefit. Mm-hmm. And if I don't die by a bus and I get to live to 90 and I need someone to come in and take care of me, that long-term care policy kicks in. So many of the older long-term care policies people bought 30 years ago are now surfacing because people are going to need them, right, and they're reading them. And a lot of them, like mine, kicks in after 30 days. And it does two different things. Those old policies, and that's why people should take them out and look at them, because we can flip them over before you get so old. If you get too old, we can't. A lot of these policies make the families pay the first 90 days. I've had several families that can't afford to pay the first 90 days. If they can't afford to pay it, they lose the policy. So all of that money gets lost because they cannot pay the first 90 days to get it started. That's a huge problem. But they never looked at them until they got to be 80. And they didn't realize, and now they don't have enough money to front that first 90 days. So,
yeah, especially if they've gotten into health issues and expensive care or whatever it might be. Medical costs are not getting cheaper by any means, the imagination, right, Debbie?
And I think people greatly underestimate what they're going to spend their money on in retirement. One lady, I do financial advising, and one lady said, can I retire now? And she was like 52. And I said, what do you want to do in retirement? Because she had about $400,000 saved up. She said, well, her house is paid for. She's got a good pension from where she worked. And I said, what do you want to do? And she goes, I want to knit. I'm like, you want to knit? She goes, I just want to sit in my house and knit. And I said, as long as you don't want to knit in Switzerland or on a European tour, go ahead and retire. You have enough money to knit. If you want to knit on a cruise, you're not going to be able to afford all that. So it's really, how do you want to retire? Do you want to retire eating cat food, or do you want to retire in a nice home? So people have to make up their mind, and nobody wants to think about getting older. Mm-hmm. The sad thing is, we're usually not going to fall asleep and go in our sleep peacefully. You're going to have some hospice. You're going to have some long-term care, and someone's going to have to pay for that. And then, heaven forbid you lose your mind in the middle of all this. You and I could probably keep working in our 90s, as long as we have our mental capacity, right? If something happens, we can work without an arm. We can't necessarily work without knowing who we are. So a lot of times it's so sad with these opportunities, whether it's long-term care or reverses, if people do not make decisions, they've made a decision. And I've gone back to see people 2 and 3 times, and they just can't make the decision. And then the next time they call me, one of the people in play, husband or wife, has dementia. They never got a power of attorney. Now I can't help them, and they have to sell their house. So they've left themselves no alternative. And that's the sad thing. Everybody has alternatives until they exhaust them.
Yeah, that's the thing. And choosing not to make a decision is it's like the whole thing. If you're failing to plan, you're planning to fail, whether you believe it or not. And it's an important thing to look at.
Right. And it's sad to say that the market is going to see more of this as people age. They're not making good decisions. So your business is going to do well. My business is going to do well. And it's going to be off the hardship of others. But there's always someone to buy the house, bring it up to code, and put renters in it. So.
Well, that's the truth. I mean, leaf backs and some other things you do. I mean, we've got a couple of borrowers that we've taken notes back on that were basically in wheelchairs and just couldn't do much. So we basically negotiated with them, like, listen, you can live in the house for free. We'll take the taxes. Just go ahead and have you go ahead and sign some documents so that when you do pass, the property reverts back to us.
Ours.
Yeah, so we can take care of it.
How long do you keep those notes? How long do you let that go on?
It's varied. I mean, I've got a couple that are in at the 4-year mark, but the thing is, they're usually lower value properties, and we usually bought them for just a nickel and a dime, very inexpensively. So it's us kind of helping to give back. I mean, there's been a few where we've just donated the property back to the homeowners. You know, I did that in Cleveland a couple years ago. We had a lady as a single mom of 4 kids. I mean, I paid like $1,000 because it was a bulk offering, and she owed the property was like worth maybe 16. She owed 40. You know, she was upside down, not anything of her own. So I just basically said, like, listen, hey, Christmas comes here. Here's your release of mortgage. You own your house. If you file it, you're going to pay taxes on it. So just don't file it and keep paying this. Yeah, you know, doing that and go that way. Because, you know.
So what happens when, so she owns the house. You guys just saved her.
Yep. Yeah. Yeah, we just saved her. I mean, we've got such great stories of helping people stay in their house or modifying and taking them from high interest rates down to something that makes sense. Or, you know, it all depends on what we end up buying that debt for. You know, especially when we see people that have they're way upside down because the market dropped in value. And so we're like, well, that's not their fault, but you still need to make some payments. So let's figure something out. You know, make a payment for every $100 extra you pay. We'll forgive 200. Or,
oh my gosh.
Or make an extra payment and we'll forgive a payment. Or, you know, make it for 12 months and then we'll reappraise the loan for the current value versus what it was 2-3 years ago and forgive you $25,000.
So you're actually buying the notes.
Mm-hmm. I become the bank.
Then you become the bank.
Mm-hmm. And then I have
more about what you do too.
Well, and it's fun. Sometimes, I'm doing wrong. I still foreclose on a bunch. I mean, I'm foreclosing on a guy in Miami right now who a house is worth 160. He only owes 80. He hadn't paid in 3 years. I'm like, listen, man, you got to do something. Oh my gosh. You know, pay, you know, stay, you know?
Right.
And then we've got another borrower who, I mean, she's doing as best she can. So we dropped her payments. Listen, just start making a payment, half a payment, and we'll credit it the first of the month when you make 2 payments. And, you know, we did that for 2 years. And she came to me the other day looking for a payoff amount. I'm like, oh, really? You need a payoff? She's like, yeah, my credit's good enough now. I can go get a traditional loan. And I'm like, nice. Bingo. That's a good win.
So if you take those properties back, are you then rehabbing them and putting them up for sale? Are you putting renters in them? What is y'all's long-term play on that?
So I prefer to keep people in their houses. So if we can get them reperforming, that works for cash flow for us. I'd rather be the bank versus dealing with toilets and tenants and trash outs. But when we do foreclose, we try to list it, have it go to auction at a price that makes sense to sell at auction. If not, we take the property back, or we'll, you know, do cash for keys, you know, deed and liens, and then we'll do some repairs, and then usually sell the property off for the most part. I don't want to own rentals outside of Florida or Texas, but a lot of our students, they use that as a way to add rental properties to their portfolio in areas that they like because they buy it cheap enough. Some cases we'll owner finance and offer up, you know, owner financing or a contract for deed, depending where it's at. So we're not having to come in and do a lot of heavy rehab. But if we have to do heavy rehab, we just try to sell it to local investors and double down, take the money back, take the profits, and go buy 2 more notes if we can. So
now I have to start listening to the show because I need to know where I can pick up some of these. So I talked to somebody else the other day, and they said they had they were in New York and they bought a property in Chicago, and they paid like $16,000 for it. I'm like, what could you possibly buy for $16,000? It's a little house. It was so cute. They sent me the picture. It was like, oh my gosh.
Yeah, you know, the thing you got to realize is I mean, sometimes you can pick up stuff that's cheap. I don't like Crook County or Chirac for the most part. You know, it's a tough place to foreclose on if you need to. But other areas around, other counties around Cook County are great. It just varies. There's a lot we see in Ohio, Michigan. Whereas,
how do you manage that so far away? Is that scary for you as an investor?
It's the same people. You hire the same people you would if you were local. You know,
you have a property management company.
Property management company, you find a local realtor, you leverage your business with local investment clubs or meetup groups with those professionals, and then go from there. And then with the notes, so we do, there's servicing companies that are licensed to do business in multiple states. So they do a lot of the borrower outreach and the communication and collect the payments, and then we get a wire and a statement. So it's not quite as hands-on as somebody who has a rental property or an Airbnb that they go out every day to do it. We do.
I don't want to go out every day and do it, and most of my people don't. I want to have it. I just want someone else to mess with it.
Mm-hmm, exactly.
Wow, I've got to learn more about what you do.
Well, for those that want to learn more about what you do, where can they get more information about you, Debbie, so they can connect with you on?
I have a couple websites. I have a mortgage website, dlbmortgageservices.com. It's just nuts and bolts of like what mortgages are and what I can do and how to contact me. I can email them a loan application, I guess, work like that. Phone is always good, 979-220-3018. I do work a lot of nights and weekends, and I do this radio show once a week in College Station, Texas, and it goes out to a lot of different markets. It's the website for that one is moneystrategieswithdebbie.com. Now that's a really where everything is housed. This interview will go there. My YouTube stuff will go there. A lot of the interviews that I do nationally and international TV as well. And then I've got a blog that's there. And so people can find me the same way like you and get more information. I think just education is what we're trying to do.
Yeah. So that's what you heard there, everybody. Moneystrategieswithdebbie.com. Best way to check her out. She's got her other stuff there, but go there. Check her out if you loved what she shared here, because she dropped a lot of knowledge nuggets today out there, everybody. She's got some great stuff online there as well, too. So, Debbie, once again, thanks so much for coming on the podcast here and sharing so many great things for people out there. And
protect your credit. Protect your credit. Save money. Don't spend it all.
Awesome. Good stuff there. Well, hey, that's going to wrap it up for this episode of the Note Closure Show, everybody. Take what you learn and apply it to your finance. And don't wait around to make decisions until you're 90. As Debbie said, start making decisions now and be kind to your future self out there, everybody.
There you go.
Go out, make something happen, everybody. And we'll see you all at the top, everybody. Bye.
Bye.